So here's the question that we received from Jonathan via email before the webinar today. And he says that ending up after a covered call or a spread trade gone awry, where you're now in a long stock position that is traded down, such as the investor who may not want to exit the stock and realize the loss, is stuck in a position with a high basis meaningfully above the current market price for the stock. So we've got a position, whether we got assigned as part of maybe a bull put credit spread that ended between the strike prices and we got assigned early maybe, or a naked put position where we got the question comes in, aside from repeatedly selling calls against it to hopefully reduce the cost basis over time, are there other techniques that might be more effective, more efficient, if the investor likes the fundamentals and doesn't want to exit the position as a loss? All right, and Jonathan's sample, example I should say, was from URI. And he's in the URI position with a cost basis of roughly $125. Now, anytime I'm in a position that looks like it has a loss, or I'm going to take a loss, I don't want to take the loss. I want to stay in the position. I feel it has more upside. But the first steps I'm going to do is loss. Where do I stand right now? And what is the significance or the depth of the loss I'm taking? Then I have to analyze the sentiment and my expectation going forward, almost as if I'm opening a new position. And then, of course, the first thing we will look is how long would it take, in theory, on the trade. Okay, so that's okay. All right, let's try that again. Is that any better? Do I have real quick? All right, here we go. This should be a little bit better. Okay, let's see. Now there. Okay, hopefully this will work a little bit better for the time. Now here we are with URI at a cost basis of 125. This was the comment that came. Okay, so ladies and gentlemen, can you hear me now? It might sound a little bit different, and I do apologize for that. Okay, still no sounds, okay, John says sound is back. All right, I do apologize for that. I'm not sure what happened with the standard procedure that we usually use, but it looks like that had dipped out. So we're going to try the phone call in now for the webinar. All right, so let's go back to square one. Here we are with URI, a cost basis of $125. Now Jonathan's position is he's stuck at 109.25, although it is up $3 today, so when he likely sent the email overnight, it was probably down to 106 or 105, but it's around 109.25, 109.50 today when I was taking a look.
So we have a loss of 1575, 1550 in the stock, or close to 12.4% of our cost basis. Now we see here we may have gotten into the position somewhere up here about a month and a half ago, 45 days ago, at around 125. And now, of course, we're down to this range of 109.50, but we see that it closed at about 106, 106.50 the day before. All right, so again, the first thing I want to look at is analyze my loss. Well, we've got a $15.50 loss on the position, which comes out to about 12.5%. Now, after I just take a look at the numeric loss and decide, well, I don't want to close it, I might want to stay into it as well. I want to manage the position because I feel it's going to go stronger. Jonathan has already reached that decision. Okay, but what we would want to do next, once we have a loss, a stock or a position goes against us, is analyze our sentiment and expectation going forward now. We know what our situation is, but what do we expect going forward? And this is a repairable position. All right. Now, myself and Ernie will tend to use Bollinger Bands, MACD, and other things as part of our analysis for the chart itself. But what else do you need to know? Well, we need to know what news or recent events came out. Was this loss a result of a poor earnings that recently came through? Was it the result of a market correction, a little hiccup, such as we saw on Wednesday of this week? Or was it the result of a weak sector or something else along the lines? What would that be? Well, let's say just rumors of a pending patent lawsuit, or a board member is planning on leaving, a CFO, a CEO, something along those lines, okay? And of course, we also need to know when is the next earnings coming up, and as well as if the stock pays a dividend, when is the next ex-dividend date? All right, because we want to know, hey, if I hold on to it for another week, I can get another reduction in maybe 20, 30 cents or so, or earnings is coming up, so maybe I should protect the downside and see if I can get a bump up in the next couple of weeks as well. So that's what we want to take a look at. Now, what I'll typically do at this point when I have a position that's moving against me is I'll go to the charts from Power Options. I'll link to big charts for the stock. And our general setup is I look at a 3-month time frame with a 20-day moving average. Some of you might be using the exponential moving average. That's fine. And I like to use Bollinger Bands, MACD, and RSI as well. Now, am I going to be able to depict a certain trend or the possibility of recovery from the chart? No, but I'm going to use what's worked for me in the past when I've seen different changes or different adjustments in certain trends, okay? And of course, then we want to evaluate, is there anything that concerns us about the chart? Was the drop we saw very recent and very sudden, or is it a consistent downtrend on the position? All right, so today, here is our chart for URI when we looked at it this afternoon before the presentation. Now, we do see that the stock has recently moved below within the past 3 days. This was probably Wednesday, and then we have, when the whole market pulled down due to political events and so forth. Then we have a settling on Thursday, and then we have a jump back up a little bit on Friday. But we're just below that sort of 20-day moving average, around 110. We're at 109.50. Now, when this downturn started, right about the price that we're looking at, the 125, or it could have been from back here, it's more likely around this area. So we got into the position at about 125, maybe when the stock gapped down here and we got assigned early. But we would have seen a downtrend here. And typically when I see this sort of MACD crossover, combined with a stock being below the 20-day moving average, just moving below it, and at the same time going towards or hanging below that lower Bollinger Band, this is usually a time that I'd look to exit the position. Now, it wouldn't have been much better. Had I gotten out maybe up here when it dropped below the 20-day moving average and we saw the MACD crossover, we might have only had a 4 or 5 point loss. And then, of course, I'd look for another crossover as an entry here on the MACD, and the stock may be moving above, so I might have got back in anyway at the wrong time at around 114 and then be in the same position where it's down about 5 points. But these are some of the things that we look for in our analysis. We try to establish, well, when I get in a position, it's usually for a positive MACD crossover. The stock had moved above a 20-day moving average. That might have been a good entry point, but the minute I saw it shift, this is sort of a false crossover signal, and the stock fell below the 20-day, that's sort of an exit parameter I would use. And an entry would be here when we see the positive crossover and then the stock moving above the 20-day moving average. But again, that was also not necessarily the most positive of signals at that point. I want to look for a greater run. But where are we now? Well, it looks like the stock has bounced off the RSI, meaning it settled down at that oversold range at about 25 or so. So it looks like the RSI is coming back up. It's getting close to the 20-day moving average, and we're starting to see a crossover, though it hasn't been fully established yet. So if I see more of a positive crossover, and on Monday the stock's above, I might use that as potentially a buy signal, especially if the RSI continues to increase. Okay? So looking at this chart, I'm not sure. I don't want to take the loss, but I'm not sure if this is a positive signal to continue moving on for a bullish repair. I'm not saying we necessarily need a bearish repair on the position, but we already know what Jonathan wants. Okay, Jonathan is in a position where he wants to stay in the position. Now, earnings aren't a factor. The next earnings aren't going to come out to July 19th. The last earnings was on around April 20th. URI fell from 119 down to about 111, moved back up to 113, and then sort of middled about there. URI does not pay a dividend. So that is out of our equation as far as what might we use to help us with a position in a decline. And then, of course, we'd research other news to see if there's anything that we should be concerned about that's noteworthy related to the sector, related to the stock as well. If I see anything that's negative, I may just want to get out of the position now, take the loss, and then look for a buy opportunity later. And that's a possibility. Or maybe double down by buying 2 puts to create sort of a synthetic straddle on the position. And if the stock does fall, I can use that profit to sort of lower my cost basis and hedge the loss on the position as well. All right, now, so our sentiment is we've done our research. This is the research I go through when analyzing what to do now that I have a loss. And Jonathan's approach is he wants to stay in it. And we first then want to analyze, well, what would it take us if we just sold calls against this stock with a loss of 1550 or 12.4%? What would we be considering? Well, here's a chain that we saw, and this was, you can see, from 221 this afternoon on URI. It does offer weekly, so we have a variety of different choices. Now, the 7-day out series, the at the money, May 110. And I don't even know, URI might be above 110 right now. We're just using this as a gauge to say if the stock stayed at the same price and by some miracle volatility stayed the same, how long would it take me to get back to break even with these prices? Okay. Well, the weekly at the money option we see here is trading roughly at about a midpoint of 180. To get back to 1550 would take us 8.5 weeks or 8.5 cycles to get back to break even. We know that's tenuous at best because this stock is not going to stay at 109.81. It's not going to stay at 110 for the next 8 weeks. And if it did stay at 110, well, the volatility would drop and we wouldn't be able to get $1.80 for the at the money option 7 days out in time. That would drop in premium. But we're using this as a gauge to think, how long would it take us to get back to break even if we were just selling the calls? How many right cycles would it take us to cover this loss, assuming the best case scenario? And that's the stock staying at 110. So we'd have 8.5 weeks. Okay, so roughly 60 days. Now, the 2-week out option, 14 days out in time, we're looking at a midpoint of about 250. So to get back to 1550, this would take us 6 cycles, not 6 weeks, but 6 cycles times 14. So we're looking at about 85 days, 87 days, somewhere in that time frame. Of course, the week 3 cycle, 315 premium, 65 cents higher. This would take us about 5 cycles, and that's 21 days out. So we're looking at 105 days of continuing right every 21 days out, getting 315. That would cover the 550 or 1550 loss. And then the 4th cycle, standard June expiration, roughly 30 days out. We'll call it 30 days out, but it would take us 4.1 cycles with a cross of 380, price of 380. So again, we're looking at 120 days. So there's benefits to the weekly, but again, we're talking about selling right at the money. So this one might not be a bad one if we think that URI is going to bounce around, maybe pull back a little, but if we think it's going to move up, we'd have to consider selling the 115 or if it offers single digits, the 111 or the 112, okay? So now we know our time cycles. We're looking at least 2 months minimum on weeklies in the best case scenario, then 85 days, 105 days, just a little bit over 3 months or so, almost 3.5 months, and then 4 months even if we were selling the monthlies, 120 days, to cover the loss, assuming no buyback costs for the options, not including commissions. Right? So we know where we stand at least in our time frame. Now, the main approach I like to use is what's called the stock repair on power options. Okay? What this tool does is allow you to put in the stock and your cost basis, and it tries to evaluate a ratio call spread that will help you get back to break even potentially faster. The tool in an instant, what it'll do is it'll simulate all the combinations of buying an at or slightly in the money call and selling 2 higher strike calls to generate a credit. What this essentially creates is a bull call debit spread and a covered call against the stock. So if the stock moves back up as you expect, then you get the benefit of the extra premium of the bull call debit plus the stock moving up in price and the premium on the credit from the covered call. Okay? So let's go ahead now and take a look at power options. We're going to take a look at the stock repair and a couple of other quick ideas. So here what I'm looking at is the essential, just the 14-day free trial on power options. I'm going to go ahead and plug in URI into our symbol field. I'm going to click on stock repair over here on the far right. Now, as I mentioned, it's a real simple interface. I just have to put in my cost per share, and we talked about $125 even. And for the presentation, we're just going to discuss 100 shares of stock. Okay, now, here's what we know. The system tried to evaluate credit spreads for June expirations, May expirations, which we're too close to, the different weekly June expirations. And what you're seeing here is the strikes that it tried to combine. And we do see a useful net credit on some of these positions. For example, out to June, there's one with buying the 110 and selling 2 112s for a net credit of $1.60. But that doesn't get us back to break even. That's why this is showing up as NA. In fact, the closest one that appears is doing the September series at a credit, where we look to buy a 110 and sell 2 120 calls for a net credit of 10 cents. Okay? Now, it attempted to build one here with the 110 and 115, and a credit was earned. However, it didn't get us back to break even based on our cost basis. Okay? So let's look at the repair details first. When I click on repair details, that's going to give me a brief description of what the position would look like. Buying the September 110 is going to cost us $9.70, and at the same time we'd sell 2 September 120s at $4.90 to generate $9.80. So we get a small net credit of 10 cents. Our cost basis was $125, but we see here our break even is lowered down to $117.45, with the stock roughly trading at 110. Well, how does that work? The break even with a 10-cent net credit should only be $124.90. Well, here's what happens if the stock's trading at $117.45. We have a loss on our cost basis of $125 of $7.55. We bought a 110 call and financed it by selling 2 September 120s. So that 110 call would be worth $7.45 if the stock's trading at $117.45. And you keep the 10-cent net credit. So now you're at break even. At September expiration, what would happen? The 120 calls would expire worthless. You could sell to close the 110 call for $7.55, sell to close your stock at $117.45, and you only needed the stock to move up about $7.30 from where it is now instead of $15 when stock trading at 110. So you sort of cut the break even in half. But unfortunately, this is a September series. It's in that range we were looking at that's at least 120 days out in time. Okay? And again, you know, I like to see things numerically. We wanted to break down what the repair would actually be, but it's better to see things graphically. So when I see a potential repair, I'll click on Analyze Trade. Okay. This will take us to the profit and loss chart with our cost basis at 125, buying one September 110 at 970, selling two at 490 for that small net credit of only 10 cents. But now you see the profit and loss chart. The break-even goes to 117.45, as we just illustrated, and you still have a potential to make 4% if the stock moves back above 120, where you'd still be at a $5 loss if you did nothing. But is there a better way? Because this is out to September, which is 119 days away. Now, if we sold the June, the July, the August, and the September call just using calls, we'd essentially just been at break even after 120 days, assuming no buyback costs for the position. This puts us at 120 days, but it still has the potential of a profit. But again, it's necessary for the stock to move up in price. Okay? So in this case, we don't necessarily get what we want with a repair. So what is the next suggestion I would make in this scenario? Well, you have a cost basis of 125. And of course, the stock is now trading down at 110. So if you have the funds to lower your cost basis, you could buy another 100 shares, let's say at 110. This would lower your total cost down to 117.50. Right, 7.5 points, about 15-point difference. And now you're lowering your cost basis by buying more shares of stock. Is that a good idea? Well, what can we do now? If you did lower your cost basis by averaging down, we could now go back to our stock repair tool and evaluate it with a cost basis of 117.50. Now we start to see a June series that could be built using the 110, 114, where the cost basis is lowered down to 113.55. So I still want the stock to recover, but again, let's take a look. In this scenario, we had lowered our cost basis. I'm sorry, we actually have 200 shares, but it would work the same now. So we have 200 shares. We'd buy two calls of the 30th June 110 strike and sell four June 30th 114 calls at 275. It's going to give us still about that 40-cent net credit. Now we've got much more money invested in the position, about 23,420. But if the stock goes up to 114, we're at a gain. A small gain of 0.8%, but you'd still be down 11 points if you do nothing. And if you sold the June expiration 110 call for 380, well, you'd be looking to deliver your shares of stock at 110 if the stock moves back up, and your cost base is only reduced down to about $122, $121 if you got that $4 credit for the 30-day out option. And this is the 6-week out, it's 30, so it's a little bit farther. But this is a repair where the break-even is now 113.55. Why? Because if the stock's trading at 113.55, you're down $4 roughly from your cost basis, but your 110 call would be worth $3.55. And we still generated roughly about, it'd be, $5.50 here, so you generated the 40 cents. So that value of the long call, two short calls would expire worthless, plus the credit you received would have you at break even at 113 rather than going up to 125. Now I know it's rough saying that you should add more money into the position in order to profit from it, but by averaging down with the stock, okay, you can allow yourself to have a lower cost basis and the repair might work better for you, okay? But a question just came in, a comment just came in, and it's also something I was going to address next, okay? What do we note about this repair, about selling a call, or about maybe doing other strategies you thought of to repair the position? Well, they are based on the stock needing to go back up. There's no miracle repair that says if the stock stays where it is right now at 110, we're going to be able to fix this position. They say, oh, well, you can do an Iron Condor. if the stock stays at 110, all legs expire worthless. You added a 4-leg spread on top of the stock, and then what ends up happening? Well, your spread expires worthless. Are you going to be able to get a $15 credit spread, not 15 cents, a $15 Iron Condor or credit spread on URI in the next month, 2 months, 5 months, or 8 months? No, you're not going to see a credit like that. It's not going to repair it. It's not going to repair it faster. Sure, if it's neutral and the stock stays at 110, you can benefit from the bear call side and the bull put, but you're not going to be anywhere near the premium you'd get based on the repair if the stock moves up slightly, or in this case, if the stock fell as well, okay? And that's the key, is that the repairs are based on the stock moving back up. This goes back to our expectation. If I evaluated the position, I'm sorry, hold on one second. Oh, okay, I want to go back here very quickly. Sorry, folks, let me just go back here. When we went back earlier, if I evaluated this position and I decided that my sentiment was that URI was going to continue to fall in price, well, I'd either buy a put and close the stock now, take the loss and buy a put looking for further gain to the downside, maybe create a synthetic straddle where I bought 2 puts, so as the stock fell, I'd get the benefit of 2 options gaining against the one stock in that situation. And then, of course, that would counter some of the loss I'm taking on the stock, but I'm still down 15 points. Unless the stock dropped another 20 or 15 points, the put values are not going to make up now what I'm losing of $35 on the stock itself. Okay? So other ideas that do come in these scenarios are things that I've heard of in the past, and we want to take a look at them. And what is missing from the repair strategy, selling calls I just showed you? Well, what's missing is protecting the downside. So someone says, well, you could do a simple collar. What's a simple collar? Well, URI is now at 109. So the idea is, well, I can still generate that call premium I wanted by selling the 110 call for either one of the weekly series or the standard series, and then I'm going to buy a cheap 100 or maybe 95 put to protect the downside. Well, you could do that. But if the stock fell to 95 and that put was exercised, you're still down 35 points on the stock, hedged by whatever premium you collected on the call. It's not solving the problem on the downside. It's sort of locking in the risk at this point. Many of you know from being at other webinars that I advocate the radioactive trading techniques of being in a position where I only had single-digit risk to begin with. So if the stock fell 12.4%, I'd only lose 4, 5, or 6% at the most. Okay? Could you do that now? Sure. I could buy an October or January put against URI, but it doesn't solve the problem. I've already got a $15 loss in. If I bought, let's say, a 115 put now out to January, well, my cost base is still 125 plus what I add to the put. So it might be at 130. I can't lose more than 115 now, but that's still at that 15-point loss from my new cost basis. But it protects the downside, but if the stock continues to fall, it doesn't gain me more. It just stops me losing. A covered combination. This is one I don't like to use, and this is what was brought up a moment ago in the discussion. This is generating extra premium in addition to the covered call idea, just selling calls where we saw the breakdown of the time frame necessary to repair it. And in a covered combination, I'd sell the call, but at the same time, I'd sell an out-of-the-money put option to generate extra premium, not as part of a bull put spread, but as just a short put. And then there's also ideas of elaborate spreads. But let's take power options here and show why I don't use a covered combination on the position. And so some of the concerns I have about that as well. So here we go. Let's go back to our 100 shares. Oh, I'm sorry, folks. I want that. There we go. Perfect. Let's go back to our 100 shares with a cost basis of 125. Now, let's go to the 2-week out series. That's usually my target range. We'll sell that 110 call. If it offers single digits, I might even go to the 111. We're going to the 111, all right? A little bit out of the money, 30-cent bid ask. So let's say we can get 220 for selling to close, selling to open the 111 strike call for 14 days out in time. I said 220. Okay. All right. So we know we're going to lower our cost basis down to about 122.80. Instead of a 12% loss, we're sort of locking ourselves potentially into a 9.6% loss. Now, we're not going to cover this with a put, but our hope is that the stock stays below 111. Now, at the same time, I'll go to the same expiration and sell, let's get at least $1. Let's go to the 106 put for $1.15. All right, so now I'm going to sell a put at 115. Okay. Now, what is the problem with this position? Now, I could make a loss of only 4.7%, about a third of what you have if the stock's trading above 111, right? You're at a 12% loss. Generating that extra premium could hinder that if the stock moves up. You keep the $2 here, you keep the $1.15 here, you get assigned at 111. So, you knock down your loss a little bit to only, instead of knowing you're 12% under now, you're only taking a loss of 4.7%, still about $11 instead of 15. That's from the option premium and getting assigned at 111. But see, the stock doesn't cover the obligation of this 106 put. Neither does the short call. So this means you just have a covered call with the same transaction at a lower strike price, the cash secured naked put, but you have to put up the $106 to cover that option. So now you've got an investment of $22,765. Your cost already into the position of $125 plus the extra $106 per share to cover the cash secured naked put. So that's where we're looking at an issue here. Why do I call this an issue? Well, if you had the money to do this, to invest more on a cash secured put, I would just buy another 100 shares at 110. Lower the cost basis of your 200 shares down to 117, and then you've got that repair that could work in 40 days, when you only need the stock to be trading at 113 to break even. Here at 113, you're still at a loss in this scenario. Okay, so that's why I don't advocate using this covered combination idea to repair a position. If you have the capital on hand to still stay invested in the covered call you're already in or in the stock you're already in, and cover the obligation of the cash secured naked put by putting up that cash, just buy another 100 shares of stock. Lower your cost basis, and then the repair will work for you, whereas you'd still be at a loss here, you'd be at a gain. Okay, you only need the stock to go up to 113 to break even. And if the stock ended up at 111, where you're at a loss of 4.7% here, that repair after you lowered the cost basis, I am pretty sure, would be higher. Or it would be much lower. It'd only be about a 1% loss, closer to the break even, as opposed to about a 5% loss. Okay, and then of course we talked about the elaborate repairs of the Iron Condor. Well, sure, if it's neutral, it expires worthless, but it's not going to get you enough to even come close to this. The premium you'd get for selling this call is going to be countered by the higher strike call you have to buy, and then you're going to sell this put and buy a lower strike put. So you need the stock to trade between these prices. Well, if it drops down to 108, the spread works for you, but now you're down another $2 or $3 on the stock. It's not a great repair using an Iron Condor, in my opinion, against this. And there's other elaborate positions that are also discussed, such as using a ratio put back spread to repair a stock. We looked at the ratio call spread, buying an at-the-money call and selling two higher strike calls in the stock repair, where it's calculated for you here on power options. But this ratio put back spread is a similar combination, but it's reversed. You're using put options, and you're selling one sort of at-the-money put. So I'll go to standard June expiration. I'm selling sort of a 110 or 105. We'll use the 110 at 380, almost the same price the 110 call was. And I wanted it a credit, so I'm going to buy two. This would be $354. I'm going to do it this way. I'm going to buy a 110. I'm sorry, I'm wrong. I'm sorry. I'm going to sell a 110 at 380. And I am going to buy 2, a reverse ratio put back spread, at, I'm going to cheat. I'm going to go 175. So I'm going to collect 350. No, I'm going to pay 350 and I'm going to collect 380. So I'm going to get a 30-cent net credit. The problem here is that as the stock falls, you've got this 5-point difference in strike price. You've got a failed bull put credit spread. And then if the stock really tanks, the secondary put is covering the loss in the stock, but it's not gaining for you. Okay, this doesn't really help you out. And if the stock moves up, do you get back to break even faster? In this case, not by much. Other ways to build is you could reverse this 2, and no one's a fan of that. So I'd sell 2 here and buy 1. But now what does that mean? That means I've got 2 naked puts at 110, one covered by a bull put credit spread here with the 105. But I have to put up the money for that second naked put. I do lower the cost basis down to 119.15. But again, I have to put up the money to cover this second short put in this ratio put spread. One's covered as a bull put credit spread, and then I've got a naked put. Why not just use this extra $110,000 here? I'm not 110,000, excuse me, $11,000, $12,000 there, and buy 100 shares of stock and use the stock repair. So that's my sentiment on these, is why I feel going with the stock repair is usually better. Sometimes you need to average down for it to work, and that might be okay because it'll work better than doing that covered combination or using this ratio put back spread to try to help repair the stock on the position where you still have to cover the extra premium of the extra short option. So why not just add more shares of stock and work the repair and have a break even of 113.55 as opposed to that? All that being said, between now and what did I mention, July expiration I think it was, with the earnings coming up, you don't have any surprises. So you might be okay selling out of the money calls to cut into that cost basis a little bit, and hopefully it keeps moving up, but it doesn't address the downside. If I were to add a put, as I mentioned, as part of a radioactive trade, how would that look? Well, remember, we've got a $15 unrealized loss on the position already. If I was opening URI right now as a married put, as a radioactive trade, I'd probably buy shares of stock at 110. And I might go to the 115 put by itself at 1320. Okay. So let me do this first. Let me show what that would look like if I was opening this right now. 110 point, I'm sorry folks, 10. This might be too high for me, but let's take a look. Oh no, it's pretty good. So we're going to October. It's about 5 months out, and I'd only have a risk of 6.7%. If I was bullish on the stock and thought over the next 20 to 30 days it'd be back up around 114 or 116, this would be a radioactive trade I would consider. However, this is not your cost basis. Your cost basis is 125. Okay, so let me go ahead and look at that. Remember, you had a $15 unrealized loss on the position, but now you're paying $13.20 for a 115 put. So the risk does stay at 16.8% at the 115 strike if the stock stays below there. You're not going to lose more than that if the stock fell to 104, 100, 95, 90, and so forth. But at the same time, it's still risking 16.8. This would only work if the stock moves up. Could you add the put and do the ratio call spread now? Well, yeah, but remember your cost basis of the total combination is up to 13,820. We probably wouldn't see a repair until at least October. If we saw one, it might be much further out in time. So I can't give direct advice on what's best for you. I cannot give you direct advice on where I think URI is going next. We showed what it might take to sell at the money calls using now maybe the 111. You're still thinking about 8 weeks if you're just using the 1 week out cycle. And then it was about 2 months, 2.5 months, 85 days if you're using the 2 week out cycle, 105 days. We saw how you could get a repair with only needing the stock to be trading at 113 or so if you averaged down and then did the stock repair, but that still did not protect the downside. The stock could continue to fall as well. Okay, so that's something you have to consider also on that position. Okay, is the downside, what is your risk threshold and what is your concern? Again, real brief, the collar, you have a cost basis of 125. Let's say you just went out 2 weeks. Oh, I showed the covered combination. You might sell that 110 call for 205 and then try to protect, let's go cheap, with the 105 put for about 95 cents or so. So again, we'll sell this for 220. By the way, this is not going to repair the position, obviously, and it's not really going to protect the downside too much. So let's put that in at 95. So here's a short-term standard collar. Well, now you're still almost locking yourself into a loss of 10.3%. You've got a loss of 12.4. If the stock fell below 105, you can't lose more than 15.2. Where, of course, if the stock fell to 100, you'd have a $25 loss, which would be closer to a 20% loss on the position. So, Jonathan, I don't have one answer for you, but I always lean towards the stock repair. And I only lean towards the stock repair, just as you talked about, just as why you would just sell calls anyway, which you're not a fan of. I'm just using that as an example because it's a common approach. Just sell calls against it until it comes back. Well, we know that just selling a calls against us can get us trapped where we're locked into a loss. If there's an unexpected event and the stock moves up 8 or 9 points, now we have to pay $7, $8 to buy to close that call, and we missed out on the gain on the stock. Now we've got a cost basis of, let's say, 130 or 131. We've got to make that up. But it doesn't address the downside. The common repairs in the position on a stock that's lost, of course, don't address the downside. You have to evaluate that in if you want to protect it, as we just showed with this collar. Is it worth it? Well, if I think the stock has the potential to move down to 100 or further, maybe I'm getting out at this point. Maybe I'm taking a $15 loss, and I'm going to look for another stock or look for URI to show me a signal. Okay? But again, long story short, I feel the stock repair done correctly is a better approach than just selling calls against it. Most of the common repairs you hear about or you talk about do not address the downside as well. Okay? All right. I had a question that came in. Oh, before I do that, my apologies, ladies and gentlemen. Let's go here to webinars. This is our public webinars page. A lot of webinars here. It's www.power. I'm sending everyone the chat link here. .com/webinars.asp. Okay. Now the reason I'm going here is if you go to this webinars page, our archive webinars is a public page. You don't need to be logged in. I've got presentations on using the Power Options tools, setting up the search, the portfolio tools to help you manage, track, and adjust your positions, finding new options trades, so on and so forth. On the option strategy section, you've got a variety of different webinars on naked puts, covered calls, credit spreads, debit spreads, including what to look for to get into a position, management of the position, and more. Under the options concepts tab here, from January of last year, manage your broken position. This is the full webinar that talks about managing a stock position that's fallen in price, or a covered call position, or a sold put that's now ITM, and also bullish spread positions. Okay, so this is the full webinar. This is about a half webinar we did. This is a full webinar and the different ideas for managing that. And you also have discussions on options exercise versus assignment, implied volatility, and more. Of course, the requested topics, this is where we post all of our Friday discussions. I'm recording this one. Unfortunately, when the recording is posted, you'll just have to ignore the first 8 minutes or so when the sound was tipping out on us. All right, but that one there in options concepts, manage your broken position, that's the full webinar on how to look at evaluating, as we did here a little bit, but evaluating once we have a loss and then moving forward. All right, so Nancy has a question. Whoops, sorry there. Can you set up an iron butterfly on EWZ? All right, now, sure, I can show you what I might look at as well, but I might just build it on the fly. Okay, sorry. Okay, it's Jonathan just coming in. He's going to look. He lost internet connection, but he's going to look at that. Okay, so I'd use the custom spread tool. We have an iron butterfly tool, and so let me go there. I'm going to go into the other strategies tab because I don't have iron butterfly selected. I'm going to remove naked put for now, and I'll go into iron butterfly. Okay, and now once I've selected that, I'll click Save Configuration. An iron butterfly now appears at the top. So I'm going to go into the search by symbol. I'll just type in EWZ for the, let's see if there's anything in May. I'll go to June. Let's go to more results. Too many. All right, so there's too many strikes here. Are these 50-cent strikes? Yes, they are. Ugh. This 50-cent strikes are not my fan favorite here. Okay, we do have some good returns. We do have some good net credits, and we do have some good probabilities. You say, wait, these don't look like good probabilities. They're all in the 29% range. Well, yeah, the Iron Butterfly is selling an at-the-money call and an at-the-money put. So combined with everything, including the past movement of the position, you shouldn't expect the probability. It's really saying what is the probability of it trading at that price. Very rarely do you expect it to be above 26 or 27. Okay, it's right at 34.96. So if I was opening it today, this would probably be my target. It's $35, the at-the-money strike. Rather than use the search by symbol tool with all these combinations, I'm going to go into the actual search tool, Nancy, and I'm going to clear out all the filters. And again, I'm just going to set standard June expiration. Now, I'm going to look for a minimum net credit. I saw some good ones there, but I want it to be at least 75 cents. I know my probability between, or the probability is going to be between the upper and lower break even, okay, is probably only going to be about 28.5% is what I should look for. It's not going to be really, there's some that were 30 there, and we'll take a look at those. And then, let's see, I don't really know really if I want anything else here. I've got a net credit. All the options, I'm sure, have some good liquidity, but I'll just make sure that I have at least 5 contracts on the sell put, 5 contracts on the sell call, and maybe an open interest of 10 on each. Oops, 10 on each. Sell call, open interest, 10 on the sell put. Not going to worry about bid-ask spread. Not going to worry about things such as the volatility levels because you've already mentioned the stock that you want. I will talk about the maximum risk. This is how I control the strikes. Is in general, when I'm opening a spread on an ETF that's under $80, under $90, I probably don't want to go higher than $2.50. Okay, so I'm going to put my maximum risk at $2.50, so none of my strikes are being greater than $2.50. At the same time, I am going to check this box down here for margin, same margin on both spreads. Right? So I don't want to have selling a 35 call and selling a 35 put, and then in the outer wing, let's say buying a 36.50 call, so I have a $1.50 risk to the upside, and then selling a 31 strike, so I have a $4 risk. I don't like those uneven spreads, those uneven butterflies or condors. Okay, now I got to go to fundamentals. Let's put in my stock, EWZ. I don't need to put in any other criteria because I know the stock. Wow, there's still 105 results that match that. Okay, so let's narrow this down a little bit more. And in general, I do 2-point spreads. So that's what I'm going to do. I'm going to put the risk of 175 to 250. Oops. Should have worked. So I only want 2.5-point spreads. These have to have them, and they get a net credit. Oh, okay. So let's go 150. See if that helps. It's not percentage. I'm sorry. All right. Okay, so this narrows it down to 26. I really like to isolate it to just a 2-point spread. All right, so I was trying to show you how to use the tools, how you could narrow this down based on your results, and you see sort of the net credits here and the probabilities around 30% for some of the best ones, 36%. That's at the 34 and the 34. I got to tell you honestly, I'd focus, if I'm opening this position today, I'm looking at the 35. And as a general rule, Nancy, what I tend to do, and it's no bearing on statistically if it's better or not, I don't trade this strategy. Whenever I'm opening any credit or debit spread, my preference, I might go 14 days out. I didn't see this offered weekly, so I might go 14 days out. I don't like the 7 days out because I feel the credit's too low. But with it being at the money, that's the whole point of the spread, is taking advantage of the at the money, and taking advantage of a 10th profit and loss chart. And I always go 2 points apart on my spreads, whether I'm 1 week out, 2 weeks out, and I'm by 2 points. Yeah, I mean 2 points, not 2 strikes. Even though there's a 34.50 here and a 34, I'm going $2 apart. I'm not going to mess around with the bid-ask spreads too much. We're just going to sell these two at the money. That's the whole point of a butterfly. If you had a bullish basis that you thought the stock was going to move up, you might do the 36 strikes as your sell. If you had a bearish sentiment, you might do the 34s. But by definition, this is a neutral strategy. So if I had a bearish or bullish sentiment, I'd be doing something different. I'd be doing a bull put or a bull call as opposed to a neutral position. Okay, here's the butterfly I would most likely consider. All right, I have a net credit of $133 here roughly, and this is in the worst case scenario. We get $1.19, almost $1.20 for the June 35 call and the June 35 put, 14 days out in time. Why am I selecting 14 days? This is based on the research that Ernie did. And when back-testing weekly spreads and weekly positions, he found that over an extended period of time, he got a better return using various criteria, adjusting various criteria, and playing with different numbers and different structures of the trade. He found that the 14-day out trades, the 2-week out trades, actually performed better than the 7-day out. Why? Well, it's because the premium was lower here, so all of the losses, when losses were taken, were amplified because of the lower premium. Getting a little bit better premium, even though it's a lower annualized return, he found out that long-term, it hedged the losses a little bit better, and a lot of times in the first 7 days, if it came close to a trigger point or a stop point, if it was 14 days out, it would come off of that, and this trade would actually expire worthless, where you'd have to manage to close it quicker in the 7-day trade. So he and I are both more comfortable using 14-day out. By definition, Iron Butterfly is neutral, so I want to be right at the strike price. Okay, so I'm selling the 35 for both. I have no idea of where EWZ has been. This is not a trade recommendation or suggestion. This is just a structure that I use. Why 2 points apart? Well, that's talked about in my management technique in those option strategies webinars, where I said there's the webinars there on managing your bear call credit spreads and managing your bull put credit spreads. I like to go 2 strikes apart from my sell and my buy, so that if the stock starts to fall, one of my management techniques might be to close the short and sell to open the strike in between. So I don't have to adjust both legs. I may still be able to get a profit, although a lower profit, by just rolling one leg down, okay, before it starts to go in the money. So that's why I like to have 2 strikes apart. Well, how is that relevant to this discussion? Well, because the Iron Butterfly is simply a bull put credit spread with the 35, and in this case, 33 put, combined with a bear call credit spread with the 35, 37 strike. So if EWZ starts to move up and it goes up to, let's say, $35.50 or $36, I may buy to close the 36 call, the 35 call, and then sell to open the 36. So I just have to roll 1 to give myself a little bit of cushion. And then vice versa on the other side. If it drops down to, let's say, $34.50 or $34.20, I may buy to close the 35 and sell to open the 34 to give myself a little bit more cushion. Now, we're only talking about 20 cents because these are still so close. But this is why I say $2 and not 2 strikes. Okay, if you went to the selling the 35s, if you went to the 35.50 call and the 34.50 put, number one, you're only going to get a credit of maybe 80 cents or so. You're going to cut this down by probably 60% because you're going to pay a lot for those ones that are only 50 cents apart. If you do the 1 point spreads apart, you're going to get a lower net credit as well. You might have a similar return, a high return, because you only have a 1 point strike difference instead of a 2 point margin requirement. But again, that's what you might consider. I don't know this stock, this ETF. I don't know how it moves. I don't know anything about the Brazilian index whatsoever. Okay? If you're neutral on this position, your break even is 33.67 and your upper break even is 36.33. All right? That's where you start to lose money on either position in the next 14 days. So keep it short term. I like to keep it 2 points apart. That way you make sure that you get a better net credit and still a manageable risk, really manageable risk in this case. No idea what's going on in the economy for Brazil, the Brazilian economy, or what would affect this. And geez, this is doubtful I'd do anything on Iron Butterfly on this right now. I never do anything here that's the, I don't know if this was that's such a sudden move for an ETF. I don't know what happened there. But man, I don't think that's something I would look at as any combination of any kind of consideration for a neutral position with this recent jump. I'd want it naturally to be in this range. This would look good. But then as soon as I saw it going here, I'm not doing an Iron Butterfly on this position. I'm doing something else. I don't know. Yeah. Yeah, she says now it crashed after the scandal. I'm sorry, Isaac says highly volatile, can easily move 2 points in one day, especially now it crashed after that scandal. Okay, so that's what we're looking at. And I don't know if this is a good idea for any kind of neutral position, not an Iron Condor, not a, and I wouldn't even say a bullish or bearish, as Isaac mentioned. He said it can move 2 points very quickly. And with these kind of 50-cent strike differences, you go beyond that range and taking on a lot higher risk. So I don't know if this is a good candidate. Can't give that advice. But again, if I were to build something and I thought it was neutral, now that it's dropped down to 34, I believe this is the structure I would look at. 10 to 14, probably 10 to 15 days out in time. The definition of a butterfly is to be neutral, so I'd have to have a neutral sentiment. And to maximize the premium, I'm selling the at the money, those with the highest time value. And then personally, I go $2 out, even if 50-cent strikes are available, so I can use that extra management technique in between. But as Isaac said, going that one step deeper, I think that's something that's maybe a little bit too volatile and something I'd be really too concerned about doing an iron butterfly on at this time. Okay, any neutral position. It might take a long strangle on it. It'd be expensive, but let's say if I did a long straddle, who knows if it's going to continue down or not. But you've got a risk of 239 and an upper break even of 32.61, a lower of 37.39. It's about the same we saw with selling the iron butterfly for the next 14 days. I'd probably go further out with this, and it would cost more, so my break evens would increase after I did further research and analysis on this position. So it depends on your expectation. Again, if you think that it's stabilized and it's going to stay at that 34 to 30, let's say even 34.50 to 35.50 range, if that was my expectation, by the way, if going back here and thought after this drop that now I think that after this scandal, after this major volatile event, the stock was going to stay somewhere around 35.50 to 34.50 or so, or maybe the stock was going to stay, wasn't going to go back up above 36 or drop below 34, I'm not doing a butterfly. I'm structuring a condor by probably selling the 36 call and buying the 38, selling the 34, and buying the 32. Okay, so I want it to stay between. I'm not going to get as high a credit as the butterfly, but I've given myself a little bit more room to the upside and the downside if my sentiment was it was going to stay in that range. As Isaac said, it could fall again. It could snap again as well. Okay. Nancy said she would put the wings further out. Okay, well, any combination is give and take. All right, so we could sell here at the money. Let's do a 5-pointer. Okay, so we're going to go to the 30 and the 40. Okay, we're going to pay probably only 8-9 cents for both. I'm going to put in 10 cents and 12 cents. This was one at 10. I'm sorry, 0.10, and this would be 12. All right, so what does that mean? That means I'm going to keep more of the initial net credit. It means, oh, bad mic. Sorry about that. Let's go back to selling these as part of our butterfly. Fantastic. There we go. All right, so now I keep more of the net credit, but I have a higher margin requirement, so the return is less. The break-evens, interestingly enough, are still about the same as the long straddle that I looked at buying the at-the-money options. So if the stock goes below 32.83 here in this, the ETF, I'm sorry, if it goes below 32.83, you start losing money. And if it goes above 37.17, you start losing money on the position. The long legs haven't kicked in yet. Whereas when I bought the straddle, if the stock went below 32.83, I'm starting to make a profit. And if the stock went above 37.17, I'm starting to make a profit. So what are your expectations? And what are your range of your goals? If this is inside your trading range, and as I mentioned, if you thought the stock was going to be between 34 and 36, this would work. Stays between both break-evens. You'd have to adjust one of the options, either buy to close the short call or buy to close the short put, to avoid taking assignment on one leg or the other at expiration. Very unlikely EWG is going to be trading right at 35 in the next 14 days, but we'll take a look. Okay. I keep that structure of the 2 points so I don't have a higher margin, and also because it helps me also control, not having a higher margin helps me control the loss on the position. It's still a leveraged position and I risk what I'm investing. And this is still low risk, believe me. And of course, you're probably, I know, Nancy, you and I talked years and years ago, and we've talked in between then, you might be doing 10 or 15 contracts where your risk would be, for 10 contracts, you're $2,830 or so to make 2,170. Not a bad risk reward ratio. You just have to be right a little bit more than 55, 60% of the time in order to profit long term. But I like to keep this more controlled. And if that means taking less credit, I'm okay with that. I mean, the spread that I built, the 2-point spread, was, I think, a $1.33 net credit, which created a 67-cent risk, okay, because it was a 2-point spread. So the most I could lose was 2 points, but I was taking in a $1.33 net credit. So it would be a consideration. The risk-reward ratio, we're not looking too far off. You're at a 1-to-1 and a little bit less than 1-to-1 here, which is perfectly fine. I was below 1-to-1, which is strange, but okay. That's a way to do it. And you say, that's all you've been doing in my Roth IRA. Yeah, I hope you've been doing it on ETFs. I mean, there have been some good stocks that have been neutral recently, but I had a couple of customers the last 10 days or so point out that they were trading calendar spreads, standard diagonal spreads on stocks that hadn't moved. Qualcomm about a month or two ago, which was one that he generated income consistently after about a 4 or 5 month period. And then all of a sudden, I think he forgot about earnings, and the stock dropped 15 or 12%. So his spread was down 40%, even though he had just collecting premium that was expiring. He'd lowered his cost basis on his call down dramatically, but it still wasn't enough with a 12% loss on the stock, where he's still realizing a 40% loss on the leveraged spread trade. And so that's what we don't want to take in these scenarios. And it's, certain things we want to avoid. And, it's always hard to avoid because you never know, but that's what we look for there as well. Okay, so that's a butterfly. And not a strategy I do. That's what Nancy's doing in her IRA right now. So hopefully that's working out for you, Nancy. I'm sure it is. Otherwise, you wouldn't be doing it. Got to be careful with the stocks and the sudden movement. And of course, I don't know how bad you got if you got hurt on Wednesday with the pullback and how that had to adjust to your positions. And then she also mentioned she's got Condors on Amazon and HD. Recent earnings on HD, which moved, but I think it was only 4 or 5%, if I'm not mistaken, and FLT as well. I did have we talked about that long straddle position, buying the 2 legs and saying, well, it's a high cost to get into it. I had a very, very, very profitable long straddle this week. I'm sure most of you know it, but it was on Red Robin Gourmet Burgers. I think I bought the 60 call and the 60 put and paid $4.50 into the position. And of course, you see now it's RRGB. So their earnings were something, I don't know, kind of the ones you look for. But let's see here, it was the May series. It was the 60s. I think I paid $285 for the call. I'm just looking here, and $218. This is some weird number like $218 for the put. I don't remember. So it's about $5, $500, and did a few contracts. So of course, you can see it's up to 72. So I lost everything on the put, but I was able to sell the calls for about $11. I closed out early. I didn't hold on to it today. Went up to $72.95. It had gapped up about $10, $11 the first day after earnings. So yeah, they put in 5 and got about $11 back off of it. So that was one of the biggest or the best straddles I've had here as well over the past few times also. Okay, and that's a. Nancy says she doesn't buy stock anymore. I met Nancy when she was at a presentation that Kurt did live for radioactive trading, and Nancy doesn't buy stock anymore. She's making money every month trading options, and so am I, Nancy, even with the radioactive trades. But I don't feel it necessary to generate premium to make money, because a lot of times that's where I see people get hurt. That the best idea isn't always to sell options, and we all know that, of course, and that kind of situation. But yes, just like you, Nancy, I recently, people heard me on webinars say about 50% of my trading capital is in radioactive trades, and then I also trade calendar spreads. I'm doing some of these long straddles for earnings announcements and things of that nature. I still do a little bit of collars here and there, but I'm also doing all of those in an IRA as well. So right now the gains are tax-free until I get old enough to start taking them out, and then we all have to pay the piper eventually. All right. Well, ladies and gentlemen, it is a little bit after 5:30. I show 5:40 p.m. Eastern Time. I don't see any other questions that have come in. So if you have any last-minute questions, I encourage you to go ahead and send those to us. I just want to remind everyone that if you haven't done so yet, you can take a 14-day free trial to the tools that we showed here today, in addition to the search tool and the portfolio tool that we did not get a chance to show, and many other tools. Just go to powerops.com. You can put in your first name, last name, and email address, and then you'll be able to start and take the tools for 14 days to have those tools available to you as well. And of course, after that, these different subscription levels, we do offer an end-of-day service where the data is just updated at the end of the day, and that is $40 per month. I'm sorry, $40 per month. A common one is our delayed service, and it gives you access to all the tools with 20-minute delayed quotes, and that's only $60 per month. You can upgrade to the back testing, the historical service on top of the delayed for only $40 more. So the historical service gives you everything with the delayed service, plus access to the historical tools for back testing, where our data goes back to April of 2006, and that is $100 per month. And of course, we do offer the real-time service at $120. Oh, sorry, folks. And if you want any other free information there as well, remember you can go to blog.powerop.com to take a look at any of that information there we have on the blog for different types of trading ideas and management ideas and strategy ideas. And of course, you can check out that webinar page at any time, and also our free YouTube channel where this webinar will likely be posted, as well as on our Power Options webinars screen as well. Now, of course, wrapping up here, let's see here. Okay, so Isaac, I'm going to have to follow up with you later on that question because we don't have the time to do it now. We are at 5:40 p.m. Eastern Time. So you asked a similar question about the PFE stock was assigned after it dropped and the calls are not bringing in premium, what to do? Well, if you didn't see the beginning of the presentation, I would still probably approach it the same way. I'd look at evaluating some of those stock repairs, taking a look at maybe averaging down, or looking at ways to maybe, if it's still going down, you don't think it's going to recover, to maybe get out of it with the loss and look for a buyback later on as well. It's something I'd look into. So if anyone has any questions, remember at any time, just send me an email to support@powerup.com. Isaac, I'll get to your question possibly this weekend. I don't know if I'll get, maybe in a little bit, I'll be able to send you an email or discussion about it. And you can, of course, get us at any time to support@radioactivetrading.com as well. And of course, you can also call us during market hours at 302-992-7971. And then anyone who's on a trial membership or subscription, you can schedule one of those coaching sessions where you can talk to